Okay, so this is tax tips for construction, architecture, and engineering firms. My name is Jessica Chisholm, and I'm a CPA with Huddleston Tax Consulting. Our information's right there on the screen, phone number, website. So before we get started, I just want to go out here to smallbusinesswebcast.com and remind you that if you haven't already signed up at smallbusinesswebcast.com, you should go there and sign up so that you can find out about future webcasts that we're having. For example, on Friday, Jennifer Zhao will be doing 7 tax tips for the self-employed. On December 1st, John Huddleston is doing LLCs and S-Corps explained, using them to reduce taxes. On December 7th, I'm doing this webcast again. On December 9th, doing tax tips for dentists. On the 14th of December, I'll be doing tax savings with real estate ownership explained. And then on the 16th of December, I do a QuickBooks overview, essentials every user should know. So you should definitely make sure you're registered there because in the future there'll be other professionals who will be presenting additional webcasts. So there might be some that you'll find helpful. Also, feel free to visit our website, huddlestontax.com. We are available for consulting, tax preparation, QuickBooks consulting, things like that. So feel free to visit our website if you need some more accounting help. Okay, so we can go ahead and get started on the webcast here. So here's the different things we're going to be going over. The first thing is entity selection, choosing the correct entity for your business, the auto deduction, meals and entertainment deduction, home office, deferring payroll taxes on owners, marketing with the energy tax breaks, and the Domestic Production Activities Deduction. So let's see, I'm going to go ahead and mute everybody so there's not any background noise, and I'll unmute everybody at the end for questions. And if you don't want to ask a question out loud, there's always the chat function here. You can ask a question there and I'll answer that. So the first item is business entity selection. When you start a small business, it's very important to make sure you're choosing the best entity for your business. There are several different choices: sole proprietorship, LLC, partnership, C corporation, and S corporation. So with the sole proprietorship, it's the easiest one to set up. There's no filings necessary with the IRS, and no additional tax returns needed. You just file it on the Schedule C on your personal tax return. The drawback to it is that you do pay self-employment tax of 15.3% on any profits. You can start an LLC. If it's a single member LLC, you're taxed the same way as a sole proprietorship, so it's just reported on your 1040 on the Schedule C. Or you can elect to be taxed as an S corporation, and then you would file an additional tax return. If you are a single member LLC that elects to be taxed as an S corporation, you are able to possibly avoid some of that self-employment tax, but you do need to take a reasonable salary, so you will have to be on the payroll. So a multi-member LLC or a partnership is when 2 or more owners are sharing profits and losses, and then you would need to file the 1065 partnership return. C corporation, file a separate tax return, and you pay tax at the corporate level and on any dividends that you distribute to yourself as an owner. So there is a little bit of double taxation there. And then the S corporation, that is a flow-through entity, so it does have its own tax return, but you will get a K-1, which then flows through onto your personal tax return. So the S corporation itself doesn't pay tax. You pay tax on your personal tax return, and you are able to possibly save on self-employment tax by paying yourself a reasonable salary and taking the difference between your reasonable salary and the profits as draws, and those draws are not subject to self-employment tax. So if you want more details on entity selection and which one might be right for your business, you should attend the webcast entitled LLCs and S-Corps Explained, Using Them to Reduce Taxes, that John Huddleston does, and he'll go into much more detail about the different entities and can help you decide which one is best for your business. So remember, you can head on over to smallbusinesswebcast.com and find out when he's doing that. So next is the auto deduction. There are two different methods with which to deduct your auto expenses on your tax return. First is the standard mileage deduction. So for 2010, it's 50 cents a mile, and you can keep track of your miles for any business-related travel. So business miles includes trips to see clients, trips to job sites, post office, bank, supply stores, etc. And especially for construction companies, this is, and you know, it can be true also for architects and engineering firms, but there's a lot of job site visiting. So it's important to keep track of those miles because it can add up to be quite a large, significant deduction. It should be noted, though, that business miles do not include trips from your home to your office. These are just considered commuting miles. There is a way to avoid that, though, and that is to make your home office your principal place of business. Then every time you leave your home, you're able to deduct the miles. And we will go over how to get a home office and qualify for that deduction. So the actual expense method is the other method. This is oftentimes the best selection if you have a 100% business use vehicle. So if you're a contractor and you have a truck that's 100% for business use, you're probably going to get a larger deduction with the actual expense method. When you use the actual expense method, you get to deduct the business portion of the actual expenses to operate your vehicle. The expenses include gas, repairs, oil changes, loan interest, tires, license, basically any upkeep on your car. You also get to take depreciation. So if you have a 100% business use truck, or you know, it can be less than 100%, but for this example, you have a 100% business use truck that you pay $20,000 for, you get to depreciate that over 5 years. So that's a lot of times why the actual expense method ends up exceeding the standard mileage deduction when you have a vehicle that is high business use percentage. You still need to keep track of your business miles to determine business use if it's less than 100%. So just keep track. January 1st, write down the mileage on your odometer. Keep track of your business miles during the year. Then write down the ending mileage on your odometer at the end of the year. And you'll know your total miles and your business miles, so you can figure out the percentage of business use. You do need to remember, though, that once you choose the actual expense method, you cannot switch back to the standard mileage method for that vehicle. So you need to make sure that it's going to be the best choice for you over the life of the vehicle. So next is meals and entertainment. Meals and entertainment are a 50% deduction on your tax return. There's an exception to the 50% deduction, and that's if meals are provided to an employee for the convenience of the employer at the workplace. So if you're working on a job site, there's no eating establishments near the job site, so you want to keep the employees there rather than letting them go and driving a long ways to get to some food and possibly risk them coming back late. So if you do that, if you provide the lunch for them, then that is 100% deductible. When you go out to a meal for business, you must be conducting a legitimate business discussion. And you must be able to answer the following questions. Who was entertained? Where did the meal take place? When did the meal take place? Why did the meal take place? And how much did it cost? So a good idea is just keep the receipt from the meal. You can flip it over on the back, write who you were there with, and what you discussed. And then all the other questions are already answered by that receipt. So that's an easy way to keep track of that. So next is the home office deduction. Like I was saying in the auto deduction, if your home office is your principal place of business, then you're able to deduct all of the business miles every time you leave your home office. So if it's possible to swing the home office as your principal place of business, then you do get that home office deduction, and you possibly get a larger auto deduction. So to qualify as a home office, your office must meet one of the following requirements. It must be your principal place of business, or a place where you meet clients, or if the office is a separate structure that's not attached to your house, or it needs to be a place where you store inventory. So if your office qualifies under one of those four, then you would calculate the deduction using the square footage method. So an example is if you have a 2,500 square foot home and your home office is 500 square feet, then the home office is 20% of your home. This means you're able to deduct 20% of your mortgage interest, property taxes, insurance, utilities, or if you rent, you get to deduct 20% of your rent, utilities, etc. You also are able to depreciate a portion of your house. So you would take 20% of the purchase price of your home less the land, and you would be able to depreciate that. One note on the storing inventory: if you use your garage to store inventory or a 100% work use vehicle, then you may be able to also deduct a portion of your garage as home office. So if you are a contractor and you have that 100% business use truck, or you have inventory from your jobs and you keep them in your garage, then that's another important deduction. So deferring payroll taxes on owners. So corporation owners who are also employees, so this would go for C corporations or S corporations. If you're a sole proprietor, single member LLC, or partnership, you wouldn't be paying yourself a wage. So this wouldn't apply to you necessarily, but if you are a single member LLC, remember you can elect to become an S corporation. So this might be something that would work for you in the future. So corporation owners who are also employees can defer some payroll tax obligations on their income until the following year. So how you would do that is you would pay a large percentage of the owner's salary at the end of the year, and then the payroll taxes wouldn't be due until the beginning of the next year. So if you're a monthly tax depositor and you pay a salary in December, the payroll taxes aren't due on that until January. So if you wanted to defer that expense into the next year, this is the way you would do it. So tax withholding on the salary is treated as if it's paid evenly throughout the entire year. So it doesn't matter when the corporate owner gets their wage. You know, they could take a small amount each month and then have a large kind of balloon payment to themselves in December, and then they would be deferring those payroll taxes. So when you have withholding on your salary for federal taxes, like I was saying, it is treated as being paid evenly throughout the year. So you can stop making quarterly tax payments if you have enough tax withheld. So you don't need to make those quarterly tax payments throughout the year, and you can have that large payroll tax amount taken out at the end of the year. And if you are worried about cash flow during the year, you know, having money to live off of, you can take draws or loans as shareholder during the year, and then convert those to salary at the end of the year. So you don't need to worry about having enough money to meet your personal needs. So next we have the energy credits, the energy tax credits that are available and how you can market those to your clients. So the American Recovery and Reinvestment Act was enacted in 2009, and it provides homeowners with the possibility of taking a tax credit for energy saving improvements to their homes in 2009 and 2010. So this is set to expire at the end of this year, but there is a little bit of time left if you want to take advantage of this. So this is a tax credit that's available to individuals on their personal tax return. This isn't a business credit, but you can market this to your clients as, you know, so basically there's two different credits. One credit is up to 30% of the cost, or a maximum of $1,500 for high efficiency heating and air conditioning units, water heaters, windows, skylights, doors, etc. The other tax credit is for up to 30% of the cost for solar electric systems, solar hot water heaters, geothermal heat pumps, and fuel cell property. So there's no $1,500 max on that one. So basically, these tax credits present a marketing opportunity for businesses in construction, architecture, and engineering firms. You can let potential clients know about this credit and market to them how you can help them implement these different improvements on their home, and point out to them that this tax credit is available to them. Okay, so the last thing is the Domestic Production Activities Deduction. This is a big one for construction, architecture, and engineering firms. So this one is also set to expire at the end of 2010. However, if you haven't taken it in past years, there's still time to amend the 2007, 2008, and 2009 returns in case you missed it. So that's why I definitely want to go over it. So the Domestic Production Activities Deduction started in 2005, and it allows many architects, engineers, and contractors a 3%. Well, it started at 3% in 2005, it increased to 6% in 2009, and 9% in 2010. So it allows a deduction for your participation in domestic production. So basically, domestic production includes any construction, engineering, or architectural services performed in the U.S. on construction in the U.S. So the amount of the deduction allowable is limited to 50% of W-2 wages paid by the taxpayer. And this does include wages paid to the owner. So if you are the only person working in the company, and you think, well, you know, I can't take this deduction because I don't have any employees, you can make yourself an employee and pay yourself a wage. So once again, if you're a single member LLC, this is why it would be a good idea to go ahead and make that S corporation election so that you can pay yourself a wage, and then you're able to take this Domestic Production Activities Deduction. And you do need to remember that it is for domestic production, so it does have to take place in the U.S. And if you are an S corporation, the deduction is calculated on your S corporation return, but then flows through onto your personal return on the K-1. And you know, if you're a sole proprietorship, then and do a Schedule C, then that tax or the deduction is going to be on your personal return as well. So that was all of the tax tips that I had. So I want to open it up for questions. I'll unmute everyone here. So if you want any more clarification or anything on anything I went over, feel free to ask, and you can ask in chat if you don't want to ask out loud. So does anybody have any questions right away?
Yeah, this is Carl Colson. The domestic activities design or whatever it was, did you say that did not apply to LLCs?
No, any entity can take that. It just is different on how it's applied. So if you're a single member LLC, you can definitely take it. It just is on your personal 1040.
Okay, and it says for domestic production includes construction. As an architect, how does that work?
If you do the design on any building that's being constructed in the U.S., then that would be domestic production. Does that answer your question?
Yeah, it sure does. Thank you.
Okay.
Hey, this is Balaji. Can you hear me?
Mm-hmm. Yes.
Okay. Can you go to a slide that talks about home office deductions, please?
I'm sorry, I can't hear you very well. What was that?
Can you go back to a slide that talks about home office deductions?
Yes. Let's see. Okay.
So you mentioned that the office space should be a separate structure. So I have a separate office room in my house, which I'm using for home office. It just has the laptops, desktops, and everything related to my business. This place is a separate place, not being shared with anything else, but it's a part of the house. Can I still deduct this as in home office?
Yeah, so this list here of the 4 different requirements, it must meet one of the requirements. So it doesn't need to be a separate structure. It just needs to be used, 100% for business, but it can definitely be just a separate room in your house.
Okay. And I can do this even if I'm LLC and an S Corp, am I right?
Yes.
Okay. Because someone told me that if I'm S Corp, I cannot do that, so that kind of threw me off, and I'm not claiming it for the last 2 years, so I was wondering.
Well, if you're an S corporation, it's a little different. You can't deduct it straight off of your S corporation income. What you can do is there's 2 different ways. You can take it based on the W-2 wage that you pay to yourself, and then the deduction would be a miscellaneous deduction on your Schedule A, or you can pay yourself a management fee and put that management fee on the Schedule C and take the home office deduction against that management fee on the Schedule C.
Okay. Got that.
What are you mumbling?
I'm going to have to turn on the air.
Does anyone else have any questions?
This is Carl Colton. That was all the questions I had. I thought it was a very helpful seminar.
Okay. And I just want to remind everybody again to, if you haven't already, to go to smallbusinesswebcast.com. And also, I'm available for any consulting, tax preparation, QuickBooks help you might need. So feel free to email me or give me a call if you need any help with that. Or if you think of any other questions after you get off here, feel free to email me or give me a call. And we'll be emailing you the PDF of the slides for this presentation, so you'll have that as a reference.
Great. Thank you very much.
Okay, so
thank you.
if there's no other questions, then is that all the questions?
Yeah. Thank you.
Okay, well, thank you, and have a good rest of the day.
I was on that call, on video.
She saw you.
No, video wasn't being sent to me.